Good afternoon and welcome to our webinar, Closing Strong, Key Financial Moves to Make Before the End of the Year. My name is Thomas Seneca. I'm the founding partner here at TM Wealth Management and excited to be with you. It's been a challenging year, a lot going on, a lot to kind of think about and prepare for as we get close to the end of the year. And wanted to just review a number of the key things that we recommend here as you get close to 12/31. As we go through this, we don't have time. We try and keep these pretty tight, so we don't have time today for Q&A. But if you do have specific questions on anything that we've reviewed, feel free to email us, fill out the survey at the end of the webinar, and let us know how we can be helpful to you. Additionally, if you'd like to schedule a quick phone call or initial consultation, happy to do that as well. Our goal here is to add value and help you make good financial decisions. One of the key things here, just as our disclosure, we are not CPAs or tax advisors. We are also not attorneys. We do work with a lot of them, so we've got some real good insights about that. But anything we review here today, make sure you review that with your tax professional or legal professionals to make sure that the advice is specifically tailored to your unique situation and the goals and objectives that you're trying to accomplish. Just a little snapshot about me. I started my career on Wall Street, working for Goldman Sachs and Deutsche Bank. I grew up wanting to be an investment banker. I've tried to rack my brain and think where that came from. Not quite sure, but yeah, so I ultimately went to graduate school, to Columbia Business School, started working for Goldman Sachs on Wall Street, and also for Deutsche Bank out in San Francisco. And I learned two really important things. I thoroughly enjoyed the experience, but two things that I learned is, number one, investment banking is not conducive to a family. And that was important to me. And secondly, investment banking can be very transactional, right? You do an IPO, an M&A transaction, and the very next day you're on to something else, another transaction. And my makeup is such that I like to build relationships. And additionally, I need to feel like I'm doing something that is having an impact on lives of families and individuals. And so that's when I transitioned to wealth management. Very interested in the markets, but I find it very fulfilling to help families and individuals make good financial decisions so their financial resources can have the biggest impact on the people and causes they care about most. And that's why we started TM Wealth Management. Just a little bit about us. Everything you need to know about us is in our logo. We are independent. I've worked for these large investment houses and they're great, but they have their strengths and weaknesses. It was important to me that we structure something where we were independent and could really focus on the client and deliver what they need versus the corporate home office saying, hey, we really need to be focusing on cross-selling or specific mutual funds or investment strategies. Secondly, boutique, right? For us, we want to be able to spend the time with each individual client rather than feeling like we're playing a numbers game, right? A volume shop. So to us, that means boutique, where we can spend specific time to customize and tailor the experience and advice to each individual client. Third, wealth management. And for us, this really means that we function as the quarterback to your financial life. Everything that's going on, we would like to be involved and provide advice on that, and also coordinate all of your other professionals, whether it's insurance, legal, tax, on down the line. We want to be able to be that point person for you, so you're not having to make 5 different calls. You make one call to us, and we can coordinate all of those professionals. And then lastly, we are fiduciary, right? For us, I think it's indicative for all advisors what regulatory framework they've decided to register under. And for us, as a registered investment advisor regulated by the Securities and Exchange Commission, we have a legal obligation to do what's in the best interest of our clients. So that's our little commercial. Now on to the meat of the discussion today. So one of the things, this has been one of the more significant tax years in history, right? Some significant changes with the One Big Beautiful Bill. There's some things that get implemented in 2025, and there's some other things get implemented in 2026. And we'll talk briefly about those. But this is just a highlight of some of the key things that have changed, right? Increased deduction for seniors in 2025. So this happens this year. A SALT deduction cap increase, right? So now it used to be that the SALT deduction was capped at $10,000. It now has a cap of $40,000. However, there are income limits in terms of where you might, the higher income you may not be able to qualify for the full $40,000 SALT cap deduction. So you want to look at here, there's some things that I can do towards the end of the year to reduce my overall income or increase my tax deduction so that I can actually qualify for this SALT deduction cap increase. Overtime pay received a deduction, tips received deductions. There was 529 plan expansions. What you can now use 529s for has been significantly expanded. We'll talk a little bit about that. Car loan interest deduction, again, these have income limits, and specifically, if you are buying a car made in the US and the income limits, the interest might be deductible. And then also, another big one is the clean vehicle credits. If you're thinking about buying an electric vehicle, maybe want to jump on that here pretty quick. Now in 2026, some significant tax changes get implemented as well. The Trump child savings accounts. This is where newborns start to get some income and accounts set up for them. That kicks off in 2026. Some increases in child and dependent care credit gets expanded. There's some increases in education tax benefits. The qualified residence interest deduction was made permanent. So now if you're deducting interest on your primary residence, the loan amount is permanently capped at $750,000. Itemized deduction cap for high earners, right? So now depending on your income, if you're a high earner, you only get about 35 cents for every dollar of deductions that you're taking. So want to focus on that for 2026. The charitable deduction expanded to non-itemizers and also changes for itemizers. We're going to talk about that because that might be something you want to accelerate, doing some charitable giving this year rather than waiting and doing it systematically like most people do every year. You may want to double up in 2025. Great. So just as a remember, kind of here's where we are in terms of the tax brackets last year, right? You can see the 35% tax bracket for married filing jointly capped out at $731,000. For those in 2025, these tax brackets are now indexed for inflation. So if your income stays the same, your tax rate might actually go down because the brackets now are growing based on inflation. So if last year you were maybe in the 35% tax bracket making $500,000 a year, this year you're going to stay in the 32% tax bracket because the maximum is at 501. So that's what's great. Let me back up just a little bit and share. Looks like I failed to turn my share my screen. Sorry about that. We'll get that set up here in just a minute. So share my screen. There we go. So hopefully now you can see the screen. Here's, again, a summary of those 2025 and 2026 tax changes. Again, two of the ones that we want to highlight on this list is the SALT deduction cap, right, for 2025, and then the charitable deduction change for itemizers, right? So this is what we want to look at for this year, what we want to highlight, and also for 2026, start getting some preparation for this charitable deduction. And then here's the tax brackets, right? The brackets that are now indexed for inflation. You see the 35% tax bracket back in 2024, if you made over 500,000, then you were in the 35% tax bracket, at least the last bit of income. This year, you're now going to be in the 32% tax bracket if you get the same amount of income. Also, just remembering, standard deductions, those have gone up, right? So married filing jointly last year is $29,200. This year it's $31,500. And there's additional impacts for seniors. Also for capital gains, whether you're in the 15 or 20% tax bracket, right? So now you're going to be in 2025, if you make over $600,000 of adjusted gross income, that's where now you start to get into the 20% tax bracket or 20% capital gains rate. So start to look at some things towards the end of the year where now you can start to prepare for whether or not you're going to get hit by some of these tax brackets. Just again, highlighting the brackets here. This is, oops, let me go back one. This looks at, kind of what you can contribute into some of the retirement plans that you've got. And one of the things that I think is being forgotten is this new 60 to 63 catch-up limit. So if you're 60 to 63 years old, there's an additional or a higher catch-up limit that now you can do in your 401ks, right? We're all probably familiar. If you're over 50, you get to contribute an extra 7,500. But if you're between 60 and 63, you can contribute another 11,250. So one of the key things we want to make sure you look at here towards the end of the year is make sure that you are maxing out your retirement account contributions, because once that year is gone, you can't go back and add more. So we want to maximize that as much as possible. So here's kind of our checklist, right? For kind of looking towards the end of the year. If you do charitable giving, take a relook at that, and we'll talk a little bit about how to do some tax efficient charitable giving. Maximize your retirement and collections and contributions. Pay attention to some tax loss harvesting here towards the end of the year, and do some asset location and rebalancing. So let's jump into each one of these. The first is, if you are currently taking RMDs, so that means you're either over 70 and a half or over 73. This is where the IRS says in your pre-tax 401ks and traditional IRAs, hey, you've been deferring this long enough. We are now going to force you to take some money out so we can tax it. And so this is just a quick example between Jim and Lisa, ages 75 and 73. If they just paid the charitable contribution that they want to do by check, the impact would be significantly less than what the benefit might be if you do a QCD, right? So their total income in this case is 135 in this first case here, because they're taking the required minimum distribution of $60,000. Then they have their deductions for state and local taxes. They get their deduction for the $25,000 that they were giving to the charity, and they just wrote a check. So that's their total itemized deductions of $35,000. Or they could have taken the standard deduction of $27,000. And so the federal and state tax liability would be $18,795. Now, if they had said, hey, we're going to do our QCD. So what that means is, instead of doing an RMD to yourself and then paying the charity, you have the portion of the RMD go directly to the charity. So in this case over here, 40,000, everything stays the same in terms of their income from pension and Social Security, but now their RMD is only 35,000 in terms of what's taxable, right? Because the 25,000 qualified charitable contribution goes directly to the charity and doesn't show up as income. And this can be really helpful, because now as you start to think about some of these income limits, like the SALT deduction and some of these other tax benefits, those are income limited or capped. And so now if your income is showing up lower, maybe you can qualify for some other types of benefits. Now you look at their total annual income is 110,000. They don't get the $25,000 tax deduction on their itemized, and so now they're only paying $13,462 in federal and state tax liability, because they're taking advantage of that larger standard deduction. And that even goes up. This would even look better if we're using the 2025 standard deduction. So if you're taking RMDs and doing charitable contributions, this is a more tax efficient way to do it. We get questions all the time saying, shouldn't I just give to charity? Isn't that a better tax benefit? Well, no, if you need the income and you're not doing charitable contributions anyway, then it's probably just better to do the standard RMD. But if you are doing charitable distributions or charitable contributions, then this is a more tax efficient way to look at it. Another thing to look at, without going into, this is a very busy slide, but really the short answer here is, if you are gifting things to a charity, maybe try gifting stock, significantly appreciated stock. Again, this would be in a taxable account, not in an IRA. And if you can gift the appreciated stock, you effectively don't have to pay the capital gains rate on that appreciated stock, but you still get the full tax deductibility benefit of what you've gifted. So looking at gifting stock to charities rather than just writing a check. Lastly, we want to just highlight what's coming in 2026. So they're starting to limit the charitable contributions. And so for itemizers, people that take the itemized deductions, there's a floor where the required donations to exceed 0.5% of your adjusted gross income before it becomes deductible. However, non-itemizers will receive a new universal deduction of up to $2,000 for cash gifts. So if you don't deduct or itemize, then you can get a $2,000 deduction for cash gifts. So let's look at this in a specific example of an individual itemizing deductions, right? So a married couple with $200,000 of adjusted gross income typically donates $1,000 to charity. This year, there's no AGI floor. So the couple could deduct the full $1,000 of their charitable gift. And this assumes they itemize, right? So they would be itemizing. In 2026, their charitable deduction will be reduced by that 0.5% of their AGI. So if they're $200,000, 0.5% of that is $1,000. So their total donation of $1,000 is equal to the new floor. So their total deduction would be zero. And these are for individuals that are itemizing their deductions. If you're not itemizing, then you get that initial $2,000 or maximum of $2,000 that you can deduct if you're not itemized. Let's look at how this might impact. So donate a lot and itemize, right? So in this case, a single taxpayer in the 37% tax bracket with an AGI of $1 million is going to make a $100,000 contribution. In 2026, they could deduct the full $100,000 at their top marginal rate, resulting in a tax savings of $37,000. Now, starting in 2026, the deduction is subject to both the new AGI floor and the cap on the tax benefit. So let's look at what the impact will be here for 2026. The first $5,000 of the donation is not deductible. That's that 0.5% of AGI. So that leaves the potential for this high income earner of deducting $95,000. However, the value of the deduction is capped at 35%. Doesn't matter which tax bracket you're in. It's just capped at 35% of the deduction. So final tax savings, $95,000 deduction because we removed that 0.5% floor. Tax savings of $33,250, right? The 95,000 times 35%. This is $3,750 less than what we could have done in 2025. So it doesn't mean that we do charitable giving specifically for the tax benefits. We do it for helping the charity and doing other things. But if we want to make sure we understand what the tax implications are of making those. So if you think, hey, maybe I'm going to take a bigger tax deduction this year, make a donation in 2025, rather than a change there in charitable contributions and the tax efficiency of those. Again, maximize these your 401k and other retirement qualified types of accounts. And again, just highlight again, the 60 to 63, you're getting an extra contribution in 2025. So you may want to look at your 401k statement, look at your pay stub. How much have I put in this year? Do the math between now and the end of the year in terms of how many more payrolls are going to go into your 401k. And some payroll providers, some companies will allow you to put up to 100% of your paycheck into the 401k or other qualified plan. And so it may make some sense between now and the end of the year to increase that, that deduction on your payroll or that contribution your 401k up to something much more significant so you can max out that 401k contribution. Again, here's some significant 2026 changes, things to be aware of as you plan for into the next year, which might change what you do moving into the end of 2025. So one, we're going to get higher limits on contributions to retirement plans, right? Whether it's a 401k, 403b, 457 type plans, potentially more into those types of plans. And IRAs, we expect those to go up from the 7,000 and 8,000 up to 7,500 and $8,600 for those over 50. The bigger change is what's coming to high earners, right? So for 2026, workers who earn more than $145,000 in 2025, prior to their the prior tax wage threshold starting in 2026, it will increase to 150, right? So 145 this for 2025, 150,000 for 2026. What that means is that now if your wages from a single employer are over that threshold, any catch-up contributions you make will be designated Roth contributions. So they will go into the Roth component of your plan, and that catch-up amount will show up as taxable income on your tax return. So might mean, hey, if I'm doing Roth contributions this year, maybe I'm going to switch that to the pre-tax, get the tax benefit this year because I know I'm going to have to put money into the Roth component next year. So a big change in terms of what's going into which vehicles within your 401k, 403b, 457 plan, that now the Roth contributions of your catch-up contributions are now going to be mandatory that they be Roth. So you're going to get, I mean, it's not necessarily bad, but it's going to impact your tax picture and the ultimate amount that might go into your 401k plan. So be aware of that. Let's skip to Roth conversions. So one of the things you want to look at towards the end of the year is, does it make sense to do a Roth conversion? That really is just taking money out of a traditional IRA, pre-tax 401k, and converting it to a Roth. Now, why would you do that? Roth vehicles, the proceeds in there, the contributions grow tax-free. Second, they have no RMDs. And third, they transfer tax-free to any beneficiaries. So all of those things make some sense. And additionally, it is difficult for high earners to contribute directly to a Roth IRA. Now, maybe in your 401k, you have a Roth component. So that doesn't have the income limits, but Roth IRAs have specific income limits that prohibit you from contributing directly to a Roth IRA. So something to look at in terms of end of year, if you have all of your funds, your retirement funds in a traditional IRA, you may over time want to start doing some of these Roth conversions so you can get more money into a Roth IRA vehicle that has tax-free growth and the no RMDs and transfers tax efficiently to heirs. So here's the benefits. We talked a little bit about there. Some of the considerations is your time horizon, your current tax bracket, tax rates when retired. And one of the key illustrations I want to make is if your investments and your tax picture stays the same, you are no better or no worse off from doing a Roth conversion. And let me just show you, let me just illustrate that. So let's say, someone has $1 million traditional IRA, and it has a 10-year growth of 70%. And at the end of that 10-year period in that traditional IRA, they're going to have $1.7 million. And we're just assuming, just for ease of the example, they're going to pay 25% on that $425,000 they're going to have to pay. And so their ending account balance is $1.275 million. Now let's come over here to the Roth IRA, $1 million. They are going to, before they can put money into it, right, they're going to have to pay the taxes, right? This is kind of a Roth conversion. And now they have $750,000 growing tax-free. We get the exact same investment, same return of 70%, which leaves them with $1.275 million. Exactly the same. So that's why I say if the tax rate and the investment performance stays exactly the same, then you're no better or no worse off from doing a Roth conversion. Now let's see what happens if the tax picture changes. This is the exact same example, but you may not have seen, we just switched the tax rate from 25% to 45%, right? So the traditional IRA, same growth, ends up with 1.7 million. But now you're in a higher tax bracket. So now you're going to have $1,000 in taxes. You're left with $935,000. On the Roth IRA, same scenario, right? You pull $1 million out, you pay the tax at 25%, you have $750,000, it grows tax-free, same investment performance at 70%, you're now left with $1.275 million, and that is all tax-free. So that's a simplified example of how a Roth conversion might really have an impact if we think tax rates are going up. Now, the response I get to this often is, well, didn't they just make all of the tax rates permanent? They did, but if we follow any tax policy, it's only permanent until they change it again, right? And if you just look at what we're doing from a federal spending standpoint, right, spending has to stop or revenue has to go up. And if history is any guide, spending has never stopped. And so revenue probably is going to have to go up, which means tax rates go up. So just something to be aware of is looking at Roth conversions. Now, again, we would never recommend that you do $1 million Roth conversion. So what you want to do is something that we call is bracket management, or fill up the bracket. So let's say you're in the 24% tax bracket, but you've only have, $300,000 of as married filing jointly of income. Well, that means you've got $94,000 left in that bracket, and you're going to stay in the 24% tax bracket. So maybe do a $94,000 Roth conversion, fill up that bracket, keeps you in the 24% tax bracket, but now you're moving $94,000 from a traditional IRA into a Roth IRA, which is now tax-free. It will grow tax-free. So Roth conversions are beneficial. For those not that are in higher brackets and have other income, you need to be aware when you do Roth conversions, everything that you're converting that you pull out of a traditional IRA is considered income. So it might bump you up into some other brackets or other tax impacts that you may not be aware of. One of those is the Medicare income related monthly adjustment amount. So we just want to be aware of that if we do Roth conversions, it may bump you up into a higher tax bracket, which might impact some other things other than just your tax rate. Another thing to look at is getting more money into Roth IRAs and doing something that's referred to as a backdoor Roth IRA. And so this is a multi-step process that you can make a non-deductible contribution into a traditional IRA, and anyone can do this. You might say, well, I'm covered by a 401k plan at work. Just means it's not deductible. And you probably don't qualify from an income standpoint for it to be deductible anyway. So anyone can contribute to a traditional IRA, just may not be deductible. You do have to file a form on your taxes that says, hey, I made this contribution, it's not deductible. But then you could convert that traditional IRA into a Roth IRA. And because it was after tax money, we don't tax that contribution again, or the IRS doesn't tax it again. It's a little bit more, there's the pro rata rule and some forms that have to be filled out. But if you can do this on an annual basis, right? Think if you're over 50, you can get $8,000. And if each spouse, if you're married filing jointly, each spouse can put money into these vehicles. So that's $16,000 a year. Over 10 years, it's $160,000 that now is growing tax-free. So something to be aware of. Another key element is tax loss harvesting, right? So this has been more challenging the last couple of years because the market has gone up. People don't have very many losses in their portfolio, but if you do, it's beneficial to realize that loss, use it to offset other capital gains. Maybe you have capital gains from an investment property that you sold, right? Capital gains or capital losses from your portfolio can help offset capital gains from other assets like real estate. So you may want to sell something. You've got to be out of it for 31 days, and then you can go back and buy it or be in something similar. So in this specific example, Joe and Sue bought 100,000 of SPY, and since then it lost $30,000. They sell it, they realize that 30,000 loss, but then they go and buy a large cap value fund, which increases to $92,000. They can now utilize that 30 offset ordinary income to the amount of $3,000 a year. So this is just what it looks like, right? They realized a $30,000 loss. They can use 3,000 of that on ordinary income. They can offset 22,000 of capital gain from that value fund that they bought. And the 5,000 they don't use carries over to the next year and keeps carrying over until they use it. Tax loss harvesting, really important. Last two comments here is asset location. Look at where you are holding specific investments, right? Everybody knows about asset allocation, right? Certain equities and bonds, alternatives, international, but asset location is where we put things that it can be more tax efficient, right? So your taxable accounts is for individual securities or investments that you've held for a year, tax managed funds, index funds, those types of things. In tax deferred account, we want things that maybe we trade a lot because we're not going to pay any income tax on that until we distribute the entire amount. Taxable bonds, high yield bonds, REITs, alternatives, these things that might distribute income that you don't currently need. So looking at your portfolio from a asset location standpoint. And lastly, we've had a really good run in large cap growth. We want to rebalance. If your portfolio, and most people's portfolios at this stage have gotten out of debt at the beginning of the year just because it's outperformed. So you want to look at your portfolio and say, hey, do we want to get it back into balance so that the risk profile of your portfolio stays the same? You get 16% more volatility, meaning more fluctuation in your portfolio if you don't do annualized rebalancing with no additional benefits of return. So you've got more risk than you may want because your portfolio has gotten out of balance. So maybe look at what your percentages should be in your portfolio. Look at the tax implications of rebalancing and look at, happy to answer any questions, share the slides, whatever would be helpful to you, make some good decisions here before year end. But really just remember, tax efficient charitable giving, maximize your retirement and college savings vehicles, and I'll throw in the HSA health savings accounts in there as well. Look at Roth conversions and contributions in terms of maybe a backdoor Roth makes some sense for you. Look at your portfolio, and is there some tax loss harvesting that you can do to make your portfolio a little more efficient? And then lastly, asset location and rebalancing. This is a great checklist as you move towards the end of the year to make sure that you are making good decisions and that you're finishing strong for 2025. Lastly, I'll just highlight, we'd be happy to talk to you if you've got any specific questions, things that we can be helpful to you with. I'll just highlight there, our role here is not sales, it's to add value. And we're happy to have conversations that add value. And if ultimately that turns into a long-term business relationship, that's great. If not, we feel that we've done our job in terms of helping you make good financial decisions. So I think we're at time. If you have any questions, please feel free to shoot those either in an email, put it in the chat. We'll respond to all of those and send those out to everyone that's been registered for the webinar here today. But hopefully this has been helpful to you to finish 2025 strong. Have a great rest of your day.